Well, we're back again for a continuing episode of our In Conversation With series. Our repeat star, Damien, CIO extraordinaire, back once again to share insights into what is and is not happening in markets and geopolitics and portfolios and so forth. I think you are our most frequent expert commentator. So clients have gotten used to your wisdom and insight. So looking forward to our conversation today, Damien. Thanks for joining. We're getting close to the end of the year. It's been another eventful year. I'm not sure it's easy to describe it as any particular thing, good, bad, surprising, et cetera. But let's start off with a bit of a look back and talk about sort of what has happened and if there's something to learn or do as a result. It's overall maybe been a good year. I mean, markets are up. So as an investment guy, that's probably a good start.
I mean, if you wanted to summarize it in one word, it'd be wow. I mean, equity markets up around 20% year to date, after a stellar year last year where markets were up nearly 25%, extraordinary. And when you think about when we met sort of the start of this year and the kind of things that we were talking about, what was going to happen, there were so many elections happening. There was so many geopolitical concerns. There were so many economic concerns, what was going to happen with inflation. And it's kind of been a lesson, hasn't it? You can have all these things that you can worry about, but at the end of the day, the markets kind of took it in their stride. It's been interesting, hasn't it?
More than in stride. It's up much more than I think any of us expected over the course of the year. And, elections all over the place, Fed movements all over the place, surprises happening globally. We tell these stories all the time about what matters and doesn't matter and what to focus on. And I think people often sort of hear them and sort of nod, but in the back of their mind, they're like, yeah, but it's helpful to, in real time, remind and say, no, really, it really isn't what we need to be focusing on. Let's look at a couple of the events over the course of the year. I'll let you take them in whatever order you want to, but we've had some meaningful things happening around the globe that maybe some people didn't pay as much attention to. We've had some things happening with central banks over the course of the year. And of course, the actual, this whole election cycle happening over the course of the year. Take any one of them or all of them in turn. But, how did, as an investment professional looking after a client's assets, how did any of that feel to you as it was happening?
It's been extraordinary in terms of the amount of things we've had to digest this year. And there were economic events like the interest rates and what was going to happen. And that was really the big one. There's been a huge amount of talk about what's going to happen with elections and the implications of that. Budgets in the UK has been something that's been very topical with clients. So there's been a lot of things to talk about. But when it came down to looking at what really matters, and those are corporate earnings, they have performed pretty well by and large. That's been the real driver. It doesn't get as much of the headlines, right? Because it's not, everything's going well isn't the kind of headline that people are going to click on. But essentially, that's kind of what's been happening with corporate earnings, because despite all this distraction about what's happening geopolitically, people are still going to go out. They're going to buy their cheeseburger. They're still going to buy their Adidas shoes, and war and political concerns are not going to interfere with that. So the U.S. economy, it has to be mentioned, has been a standout. I think that's been kind of a surprise for those who try to sort of speculate about what's going to happen in the short term. And I'm glad that we don't try to do that, right? I mean, can you imagine trying to do that over the last couple of years?
Well, it's even if you get it right, which is maybe a coin toss, to understand the implications of getting that right. So this X event was going to happen, even if you happen to get that right, to then have understood correctly all the implications of what that meant. Right? It's just crazy to think you can do that with any kind of consistency or insight.
And there were a lot of legitimate reasons to take risk down, and
we saw competitors doing that,
and people did, and a lot of our peers did, and with good reason. They were concerned about how things would unfold, and it's just been extraordinary how that they've had a tough time because of that, because they've tried to time markets, and that's why we don't time markets. We're very much looking to the long term, and the long term has kept us in our seats. It's kept us in our positions. And that's why our clients have done well this year.
Let's stay on that. I was going to come back to that later, but let's just stay on that since we've arrived there. Can you give a really high level sort of sense of what were some of the elements in our portfolio positioning that helped drive some of that positive performance for clients and client portfolios? And just on a perspective basis, some of our peer portfolios that we're aware of weren't performing as well. And so where was the difference? What have we been doing that's been helpful? And we noticed some others, maybe because they were taking risk off the table or trying to second guess markets, maybe missed out.
Yeah, well, that was it. A lot of people took down their risk exposure to equity markets, in particular the US equity market. We didn't do that. We maintained our exposure. So that has been a good position last year. It's been a good position this year. And that's performed really well. And of course, we can't talk about the US market without mentioning the Magnificent Seven.
Yes.
And those companies, those Magnificent Seven, are the companies that are playing the AI theme. And it's not unusual to have large companies driving a market, from one year to the next. And, history is replete with examples of that. What is unusual is to have a lot of large companies really been driven by the same theme, right? So, we have 3 companies now in the US, NVIDIA, and if you don't know about it, you should.
I don't know anybody that doesn't know NVIDIA. A taxi driver the other day who was telling me about NVIDIA, I'm like, oh my goodness, here we go.
Exactly. Well, it's the biggest company in the world. It's 3.5 trillion in size. And if you take that together with Microsoft and Apple, that's 20% of the US market in those 3 companies. And we've benefited from that. That has driven the market. In fact, probably 2/3 of the market performance this year has been driven by that. So for those who haven't had exposure to those companies, it's been a really rough time.
Let me ask you a question that's impossible for you to answer. Yeah, I know you like those. So the idea of the market participation broadening seems like it has to happen at some point. Is that something we look at as a risk, or is that something we look at as an opportunity?
That's more of an opportunity. Yeah, we've quite diversified portfolios. So if the benefits of AI spread out to the rest of the marketplace, if the efficiencies that everyone's talking about extend to more than just parlor games, that there is a real change in corporate profitability, then that will benefit our portfolios. Obviously, we've exposure to the Magnificent Seven, but we also have exposure to the wider US marketplace, and that would definitely help our portfolios. So we've had a good journey so far with the Magnificent Seven. At this point, getting a little bit cautious.
Okay.
Valuation's a bit rich.
Mm-hmm.
It's been a good journey. We wouldn't be surprised to see some volatility there. And indeed, in the last quarter, we're starting to see that. So Magnificent Seven, really since around June this year, hasn't really driven the marketplace. That was all of last year, first half this year. So maybe things are starting to change, or maybe it's just a pause.
Right. Yeah, it's hard. We won't know until we look backwards and
Right.
see. And to some degree, we don't exactly care what's happening in the near term, but the reality is that over time, it's more likely that we get some type of re-engagement with more broadening and participation, which sounds like it's a positive.
Yeah, absolutely. And I think it would be a healthy thing for us to see broader participation, that we don't have the market driven by such a small group of companies. I think that would be much healthier for the market dynamics. And I'll probably sleep a bit better knowing that too.
I think I know your answer to this, but it is one of the questions that wealth advisors and wealth managers and anyone talking to clients have been getting all year long to some degree, increasingly towards the end of the year, in part because of some issues with the UK budget and expected change in capital gains rates and so forth that were being whispered for months. But the underlying question, regardless of what was driving it, was, markets are up, my wealth is up, my portfolio is up, should I be selling, should I be worried, et cetera. It's probably not a one-word answer, but it is a question we get a lot, and your perspective would be interesting.
Sure. We would always advise clients to stick to the discipline of being long-term and not to get dissuaded from that that goal of focusing their portfolio on the long term, it's very tempting. Behaviorally, we all have emotions about investing. We shouldn't.
We're human animals.
But
How
we're
do we
human,
avoid it?
and we can't help get nervous if the market falls a few percent. But it really, the last 2 years demonstrated the importance of not getting too caught up in the short term. Staying the course is really, that is the kind of advice that has benefited people. That's what's distinguished, the rich from the really rich is the power of compounding. The longer you're in the marketplace, the more likely you are to make more money. And that's just the simple reality of it.
Yeah, I find it difficult to convey accurately that question is essentially a market timing question. Because when you say to someone, you shouldn't try to time the markets, people nod knowingly again and say, of course, of course, of course. But then they come back with something like this and say, yeah, but obviously everyone sees markets are up and everyone sees capital gains are going to change. And clearly I should sell and then come back later and so forth. And ultimately, regardless of how you dress that up, that's a market timing question.
Right. And do you see, from a wealth planning perspective, have you noticed a lot of people this year getting concerns like that about the markets being up so much? They've made quite a bit of money in the last few years. Are they thinking of taking money or taking risk down or, incurring those capital gains now?
Yeah, and I think that's a natural thing to think about, and it's a healthy conversation to have. I'd rather someone voice it and speak about it than either worry about it or act without speaking about it. So, raising it is always more positive. And to be honest, there are occasions where it makes sense, right? It might make sense to accelerate a realization now versus something you were going to do in 6 months or 12 months time or various things like that. But if you're doing it simply because you think you can game the market because you know something about future market movement, that's where you fall foul. So if you delicately ask a couple of questions about what's behind this, is it fear, is it greed, is it supposed insight, or is it need? When you start to really understand what's driving this and apply that to a plan that we have for an individual client, a plan that you have for portfolios long term, then you can very easily sort of start to parse, does this really make sense? And it can, but it's infrequent.
Are clients relatively happy with performance given the environment we've had? I mean, it's been a pretty good year. The question I often get asked is, what's the long-term expectation now, given the returns have been so good? What do you say to clients now that, we've had this run up?
Usually I tell them, you have personally guaranteed all the returns in the portfolio.
Okay.
That's a joke. No, usually I tell them that what you really care about is not what, the S&P has done or some other investor about has done, or even just on a raw basis what your portfolio has done. What we care about is performance relative to something, and the relative to is relative to your plan. So we have a long-term plan for your wealth goals and what you need to achieve. We need to achieve a certain amount of growth to get there. If you're doing that or above, that's great. If you're not doing that, then we need to think, is that temporary or is there some structural change that needs to happen, et cetera? And so refocusing on their needs as opposed to, what they're reading in the paper or what they're seeing someone else do, what have you, is the first part of that conversation. But to answer your first question, I think clients, I'm not sure I can speak for all clients, but clients, I think, are broadly pleased because markets have been up. They're all feeling that in the portfolios. And there's always a bit more of a sense of ease and peace of mind when there's noise in markets, when there's political change, when there's things happening, and you can look at your portfolio and see that it's maintained value or gone up. I think that's certainly helpful. Just going back again on part of what's happened over the course of the year, one of the big changes over the year has been the central bank cycle around rate changes. Again, uncertain in terms of when they happen and how much they happen and so forth. But that's an important sort of element. It would be great to get your perspective on what we've seen so far, if it's been impactful in any way in terms of markets and portfolios and how you're structuring portfolios.
Sure. I mean, I think going back to the beginning of the year, this was the big question: is what's going to happen with inflation? What's going to happen with growth? And we've described to people over the year this idea of the Goldilocks scenario, whereby inflation comes down gradually and and growth keeps going, keeps chugging along. And the Goldilocks scenario is it's the economy's not U.S. economy's not going to be too hot where we have inflationary risk, and it's not too cold where we have recession risk. So we've got to stay within those tram lines, and that's really what's happened this year. And the Fed, by September this year, as you remember, on the 18th of September, they decided to lower interest rates by 0.5%. And that was significant. They won't say this, but that's as good as you're going to get mission accomplished in the fight against inflation, right? So now that that's fading into the background, and that's not to say that inflation's not going to come back again, because inflation is going to be volatile. We know that. But it's probably going to be less of a concern. There'll be cyclical forces rather than structural. So we don't think inflation's coming back and here to stay at those levels. And that's meaningful. And even when we see some inflationary data in the marketplace, the markets are kind of taking it in its stride, because I think the bigger focus right now going forward is going to be growth. Is the US economy going to maintain the driving force that it's had? And that's the big question. And a lot of the US growth in recent years has come on the back of a huge amount of debt.
Yes. Well, yeah.
And that's going to be a watch point going forward,
Right.
is how big that debt gets. So there are things to focus minds going forward. There won't be inflation, but it's likely to be growth. And it's likely to be looking at, to the extent that bond yields might rise, because the market's concerned about the level of debt, national debt, which is now about 35 trillion, I guess.
In the U.S., yeah. Yeah, a big number. There's some complicated relationships there that we should wade into gently, but not avoid. So you were talking about the size of the U.S. debt and managing that, and debt's everywhere, frankly. Part of that is helped if interest rates are lower. You also talked about bond
Do you know what
yields
the
going
interest
up.
payment, the interest payment on US debt now this year is 1.2 trillion.
That's unbelievable. Just to service the debt.
Just servicing the debt.
That's got to be one of the larger line items in the federal budget.
Right.
It's huge. So with rates coming down, that will potentially help that some. But what the Fed does with short-term rates is not the same as what the markets do with bond yields. And you were talking about bond yields potentially going up. There's a couple of topics in there, right? So there's a relationship between yield and price for bonds. As bond yields go up, bond prices go down. That could have a negative effect on portfolios, right? If we own those bonds and yields go up, prices go down, that doesn't help the bond element in a portfolio in terms of performance. We've benefited more recently with higher rates, so that bonds are actually contributing more positively to a portfolio. So how are you thinking about sort of the role of bonds in a portfolio? Because we had a lot of years where it was helpful as a risk mitigant, but not really helpful as a big return contributor.
Do you remember the yields we were getting prior to 2022? I mean, zero in many countries. It was negative. It's extraordinary. And 2022 was a step change, and really bonds got interesting again. The expected return, and that's kind of how we frame these things, is what's the long-term expected return from different asset classes. And that changed significantly in 2022, and we saw interest rates moving up. And now bond yields are around 4-5%. That's kind of interesting for long-term investors, because you get coupons. So yes, there is volatility in the price, but you're also getting paid to stay the journey.
Right.
And what we have done is we have increased our exposure to the sensitivity to interest rates.
Okay.
So that the portfolios now benefit by interest rates coming down. So for instance, a driver of performance more recently was the interest rate cut in the US. That helped bond markets, and that helped drive performance. So over time, we would expect that were interest rates to fall further, that would be a driver of further performance.
Source of positive contribution. Yeah, hopefully. Yeah. Another element in this is, and this is something that clients do talk about is because we're back in an environment with some yield, with some income, there's this issue around cash holdings and getting sort of paid for that versus bonds and each as potential risk mitigants to risky assets, equities, and others. But in an environment where central banks are lowering rates and therefore the cash yield on cash is likely to continue to trend down, maybe it's worth talking a little bit about sort of cash and bonds in this environment.
Right. I haven't been to the US in about a year or so, but I gather there are lots of ads for by banks for deposits, and
Capturing assets as much as possible.
CD rates are quite attractive. And I can see there's about 6.5 trillion has flowed into money market strategies. And that's great if you expect interest rates to keep going up. But the Fed has just reduced interest rates, and they've said we're likely to reduce them further. So that makes them less attractive because, as we discussed, bonds tend to go the opposite direction. So if the interest rates were to fall, then the bond price is going to go up. So in that environment, you will probably, if interest rates fall, you will do better in bonds than you would do in a money market or cash-like instrument.
Yeah, I've tried to explain that to people in two different ways. One is that cash can't hold on to its yield. It varies daily often, but you can have short-term cash deposits that are a little bit longer than that. So it can't hold on to its yield quite as well as bonds can. It can be stickier once that bond is issued. You're sort of locked in for that income stream, which is helpful, is one key difference. And then the other key difference, of course, as you've noted, is as interest rates go down for cash, you just get less. Whereas with interest rates go down for bonds, you get a price appreciation. So that difference in performance and how they react to that sort of same environmental change is a conversation that we don't get to have with clients as much, but clearly in portfolio construction, you're thinking about this.
Yeah, and I think it'll be interesting to see if we do start to see some volatility in the marketplace. There is this 6.5 trillion sitting in the sidelines.
It could come back
That could come back into the marketplace.
Quite a tailwind.
At quite a tailwind. And also you've got the Fed with rates, close to 5%. They can reduce rates. So there's a lot of ammunition there now if we were to go into an environment of volatility, from an economic standpoint, if we were to see something like a recession materialize. I'm not saying it's happening, but these things do happen every so often, and now the Fed has a lot of ammunition to do something. It didn't have that up to a few years ago, but now it's in a better place to be able to reduce rates, and also we have all this cash that is looking to come into the markets at some point potentially.
That could be helpful. I always want to take advantage of having you in these sessions sort of in front of clients virtually to revisit some topics or help teach some things or remember some things and so forth. And one of the questions that still comes up in client conversations is a lack of full understanding of our investment approach. A sense that it's
That's because the wealth manager hasn't done a good enough job.
I'll hold up my hand there. I think they run out of patience by the time I get to the topic. But there's this conversation around passive investing, and of course, that's not quite what we do. The fact that we don't trade the portfolio every day is not the same thing as being passive. The fact that there's a lot going on under the cover in the investments that we have is maybe not so visible. So it would be great, without getting too crazy technical, but just a useful reminder for how we're investing and how that's different than maybe a classic passive, because there's pros and cons to both. There's just a little primer would be helpful.
Sure, absolutely. I mean, the way I look at it is, and maybe we've got to do a jargon buster, but
Yeah, probably.
But passive is essentially getting the market performance, S&P 500, and having an active investment approach, as we do, is the chance of getting better than the marketplace.
That's a great starting point. That's
so
good.
It might be better, it might be worse, depending on your time period. But our goal over time is that we would be able to deliver outperformance. And the reason we do so is because we're focusing on the things that have typically driven outperformance in the marketplace. And what are those things? Those are things like the price of a company. Those are the profitability of the company. those kind of metrics are things that we really lean on to help deliver that outperformance.
And the academic research supports that, where it's not just our idea. We're looking at decades of academic research showing where those drivers are coming from.
Yeah, absolutely. I mean, going back over 100 years of history, which we can do, we can show, you can see that these things are key drivers. Now they're not there every year, and some years it doesn't work, and sometimes it's challenging for our strategy. But over the long term, if you look at the performance, it's been pretty consistent. If you look at sort of 5-10 year time periods, it's a really significant driver of outperformance. So that's why, and it's really leaning, as you said, on academic. There's a lot of academic papers that have been written by Nobel laureates who have recognized this. It's not just our work, right?
Yes, we didn't come up with this idea.
No, we're standing on the shoulders of these Nobel
giants.
laureates.
Yes, exactly.
But it's and it's an important distinction, I think, between active and passive, and it's something that I think people don't really understand as much, but it's going to be more and more important going forward, because the difference between the two may diverge. I expect that we will be explaining this for the rest of our careers, because it's always a question I get asked about active versus passive. And it's been a challenging time for active managers. And I would make a distinction when I talk about active managers, in that there's the stock picker, right?
Yeah.
And then there's the more sort of
systematic
or the more broad, diversified approach to investing that we like and prefer. And I think it's been very challenging for the former, for those guys who are trying to speculate, is Nvidia going to beat on its earnings, and they're crossing everything hoping that that's going to happen. And that's been a really tough time. The numbers show that active managers, those traditional managers, have had a very tough 5 and 10 years.
Yeah.
And it hasn't been as tough for diversified strategies. They've done better.
Right. When I think about clients or just investors broadly, even.
Did I explain that okay?
Well, we're not done. You're coming back on that. So when I think about clients or investors, for me, a lot of it is about alignment. Alignment with what they need, alignment with what they care about. That's true about having a traditional portfolio versus a sustainable one. That's true about how much risk they should be taking, et cetera. You've described that for an active approach like the way we're doing it, in a diversified, systematic way. If I can put words in your mouth, it sounds like the pros and cons on that in a simplified way are: you are seeking to outperform is the main pro, and the main con is you may not. Right? It may not always happen, or the manager might struggle, or what have you. So you're taking very specified types of risk exposures to areas where the academics tell us you get rewarded for those risks, not every day, but on average over time. And that's what we're trying to do. So the pro is, hopefully trying to outperform, and the con is that may not happen. With the more classic passive, the just trying to track the market passive, what are some of the pro-con considerations, just to sort of understand alignment issues?
So you mean in terms of the nature, the contrast between sort of passive?
Like for classic passive, why would you not do it? Why would you do it?
Well, I think for passive, it may be for people who don't know that there is a better way.
Okay.
Which is fine. It's not a bad place. It's market. You're getting market returns, and that's a big part of our returns anyway, right? So even if you do outperform, a lot of the absolute number is going to come from just the marketplace. Passive, I think, has to contend with whatever's happening in the market. You've got to buy it. So if the market is going through a certain fad where something is popular, and this happens from time to time, you and I lived through the tech bubble.
Oh, yes.
And we remember it well. And the market, if you own the market, you have to buy whatever is going up.
Right.
Regardless of whether it makes any sense or not. If you're active, you don't have to do that. So you can decide, you know what, this is a fad. I'm going to sit this one out. You might have poor performance as the market continues to go higher because of that fad, or fashion. And when it comes down, you look like a hero.
Fingers crossed.
So there's different environments where active and passive tend to work.
Right.
And we've been through an environment which has been particularly hostile to active, largely because a lot of money has come in when interest rates were low. So that has been a very conducive environment for passive investing. And the cost of investing from a passive perspective has got incredibly cheap.
That's true.
And that's been very attractive. So for buyers who are investors who are very focused on the costs, that then they would want to consider passive. If you're prepared to pay a little bit more, then you get that chance to do a bit better. And that can be meaningful over a long period of time as those returns compound.
Yeah, perfect. That was wonderfully described. Thank you for that. And I'm going to take advantage of you and ask for another teaching moment using this year, using the reflection in this year, because another one of the topics that comes up much less frequently is around market interventions and the idea that somehow this is going to be helpful. And we have an example this year, right? We had a dramatic attempted market intervention in China, trying to directly sort of impact and influence markets and so forth. Probably a lot of people who aren't living markets day to day may not have even seen it or seen if it worked or didn't work or anything. So again, without getting too crazy technical, let's use it as a learning point. Maybe you can give a quick explanation of sort of what happened and then what happened.
China, the Chinese economy has been in a difficult place in recent years, and they've got some structural problems. They over-invested in property, and it is now about 15% of the Chinese economy. And a lot of debt was built up over the last decade or so in building properties that now it turns out people don't want or need. There are problems in terms of debt. Local governments and the government-owned enterprise have borrowed huge amounts of money. So there's a lot of debt on the local government and the sovereign enterprises balance sheet. And also population's changing. It's aging. Not a lot of people realize it because it's the most populous, well, it was the most populous.
India I think
is
is just,
that's
yeah,
right.
right.
Absolutely right.
Yeah.
And the population is now declining, and it's aging, similar to Europe, and that's creating challenges. They had the one-child policy for a long time. They've changed that now, and since 2022, the population has been falling. So there are a number of headwinds, and the Chinese economy is what they called a command economy. Well, what that means is that the Chinese government can really dictate things and say, we're going to do this or that, we're going to lower borrowing, we're going to increase borrowing, we're going to do all kinds of things to stimulate or not stimulate or regulate or not regulate things. So there's an awful lot of things the the government can do if it so wishes.
So that's way more than our stimulus. That's putting the hand on the scale in a way that we don't see in
Right.
sort of Western economies.
Exactly. And in the last few weeks, they decided to start stimulating, and they started stimulating in a very significant way. It's a stimulus with Chinese characteristics. Okay. It's quite large.
Very forceful.
And quite forceful.
Okay.
And so much so that the Chinese market jumped about 30% in, I think it was about a week, 10 days or something like that, which is extraordinary. And I think, again, it speaks to our approach and how difficult it is to anticipate these things. I mean, no one's going to get a call from the Chinese government to say that we're going to do this or we're thinking of doing this. These things just happen, and you can't get that. By the time an investment committee has got to meet and decide on what they should do, you've missed it. The rally has already started to give up some of its performance. So again, I think it speaks to our philosophy about trying to not time markets and stay the course.
But also having diversified exposure. Right. Because presumably in some of the emerging market portfolios, we still got some of that.
We do, yeah. Yeah, it's a smaller percentage. It's approximately 20% of the emerging market index now. China, but yeah, we have Chinese exposure, and we benefited from that rise. And emerging markets has actually been a significant performer. The investments we've made there over the last 3 years have done really well, and they've been driven by those things that we rely on, which is, buying companies that are reasonably priced, that are profitable. And that's been a real winning formula in emerging markets over the last 3 years. We expect that will probably happen more so in other markets going forward, because it doesn't happen or coincide in different markets at the same time.
You make this sound easy. Or at least make it sound clear and logical.
Well, hopefully. But it's been very interesting. And we've a team out in Hong Kong that we talk to regularly, and we get an insight on what's happening on the ground there. And there may be more stimulus coming. It wouldn't be surprising, but we have to be cautious about whether this is going to make significant changes, because the headwinds that face the structural headwinds that are facing the Chinese economy are pretty strong, pretty substantial.
One of the things we talk about from time to time are, what's coming in the future, which we have no good insight into. But more importantly for our clients is, what are some of the things that we are aware of? One of those things has been a continuing shift that you've been doing in portfolios towards ETFs. We've touched on that a couple of times. I'll ask you in a second just sort of update how that's going. One of the things we've talked about over time is the shift in bond allocations you've done. We've touched on that, but if there's maybe an update in terms of what people might see in portfolios over time, if there are further shifts there, I'll ask you to sort of make a comment on that. And then the last one I'll put on your plate, and you can take them in any order, is around sustainable portfolios. We've talked about that in a couple of prior sessions. There's been a lot of noise in the market as there's been efforts to improve or at least codify the nomenclature and the labeling and so forth, because that's been so fraught for so long. It doesn't impact us that much, but we did sort of change some of our portfolio names. So if there's any updates on sort of progressions or changes around those three topics, around the ETF migration, bond portfolio allocations, or sustainable portfolio labeling, we can touch on any of those if they're relevant.
Yeah, absolutely. And I noticed you're wearing your B Corp badge. Do you want to maybe quickly explain to everyone what?
I'm always happy to do that. As MASECO was one of the founding B Corps here in the UK and has proudly been a B Corp since 2013. It's a topic I'd love to talk about. It essentially simply means that we are one of thousands of companies that try to balance being profitable and growing with how we treat our staff and how we treat our customers and how we treat the environment and the communities in which we work, recognizing that it's not just about maximizing profit, that's not the sole goal, that we have multiple goals we're trying to achieve at the same time, and that actually sustainable growth that can happen in the long term, needs to not be just maximizing growth, but needs to be sort of balancing these other important factors along the way. And so that leads into this sort of the sustainable investing theme. It makes sense that that's something we would offer clients where, the values are aligned.
Yeah, we have a significant amount of our business invested in these strategies. And it's been an interesting year, really, in that perspective, in that we've saw a lot of the regulators trying to navigate it, as you say, and they're trying to battle with this greenwashing a challenge, and that's been significant, and that's created a lot of uncertainty for all actors in the industry, right? From those who invest to those who provide products. How do you label your product? All these rules have been changing, and it's created a bit of uncertainty, but hopefully more of that is in the past, and we can move forward, because, as you say, there's a lot of merit to these strategies over time. It's important that we think about sustainable growth. And I think going forward, we will see that become a significant part of our business. And we believe we've got the right products to deliver on that, because we're making that trade-off between the companies that have the right sort of characteristics from a sort of like carbon metrics. So we look at the carbon intensity, and we weigh that up against the other metrics, the investment metrics, like the cost, the value of the company, and the profitability of the company. So there's this trade-off that goes on in the portfolios, but we have really reduced carbon intensity in our low carbon investment models.
And I know for some clients, that's really important. It aligns with their values. It aligns with the firm's values. And for other clients, this is not something they're focused on now. So it's important to sort of have the choices so that we can hopefully, to a greater and greater degree, align the solutions we're able to offer with what the clients, what individual clients sort of need and want and fits them and so forth.
Yeah, absolutely. I want to get one of those B Corp.
I will get you one for next time, I promise.
But on the other areas like active ETFs, that continues to be a real focus of interest, not just from our clients, but I spent a lot of time in talking to people in the industry, a lot of people in a similar position to myself, because it's a relatively new product, for people who've, think they've seen it all. Active ETFs is a relatively new product. So that's been interesting, explaining to people why we invest in it, what the advantages of it are. And those are the fact that you get a lot of the qualities of an ETF in that it's cost effective, it's flexible, you can trade it any time during the day. And importantly for us, it's tax efficient. That's the key one. Yeah, that's really been significant. So that's why we have such a significant exposure to active ETFs in our portfolios. And that's why I've been talking to so many people in the industry about what we're doing,
right,
and why it has become such a big trend, notably in the US, and it's coming to Europe as well.
And so in terms of our migration, is there a lot more to do that's available to do, or some things we just don't have the available options that we would like? So how far along do you feel like we are in that sort of migration?
It's been meaningful in the last couple of years. It's been quite significant. The number of products that have replicated themselves from mutual fund into an ETF equivalent has been really significant. And so the choice was limited if you go back maybe 5 years ago. But today, there's absolutely no problem in creating a very diversified portfolio across asset classes in an active ETF format.
Fantastic. And the bond portfolio allocations, you're sort of happy with where we are, or are there shifts that you are still in the process of implementing?
Yeah, so bonds have been really interesting because of this dynamic of what's happening with interest rates.
Yeah.
And Fed has reduced interest rates, which has boosted the performance of our bonds because we've increased the sensitivity to falling interest rates.
Yes.
So that's worked out. The Fed have said they're going to continue to reduce interest rates, which should, again, because we've increased sensitivity to falling interest rates, that should increase the bond prices. So looking forward to that boosting performance. And the nice thing about government bonds in particular is it acts as a sort of great ballast if you get into difficult times. If an event happens somewhere in the world, some sort of a negative event, whether it's geopolitical, political, or economic, the first thing people tend to do is buy US government bonds, and that drives the price up.
Right.
So having more exposure to that gives you that bit of balance that even if we do get into choppier waters, that we've got something to stay afloat and make sure that our portfolios are not as volatile during those environments.
Damien, without getting into numbers, because it's impossible, because we have too many portfolios and too many different risk categories and different currency allocations. So this is not a, quote me a number question. But one of the things we often talk about is, with prices up, so markets going up, prices are up, that often means expected returns come down. And I think there's some fear that even if you don't sell out, if you stay the course and you take advantage of long-term holdings and long-term compounding and all the positive things of staying the course, that the expected returns going forward may be less attractive because prices have gone up so much. So I think it's useful to just dimensionalize, again, without the numbers, that, if that is true, if expected returns are changing, interest rates may be coming down for bonds, et cetera, is it a small change? Is it a step function change? Is it just to dimensionalize that so that I think these unvoiced fears can have some sort of just framing around what that really might look like. And again, this is averages. This is not a prediction.
Right. So we have a framework of long-term capital market assumptions, which is a very fancy way
It's very fancy.
of saying what are equities going to do or bonds going to do going forward. And there's no science to this. This is a framework. So we have to contextualize that. We have to discuss it, and we do at our investment committee.
So we don't pretend that it's predictive. We don't pretend that it's specific. It's a guidance.
It's descriptive. It's descriptive of what the outlook might look, given where valuations are at any point in time.
Perfect.
And it would be great if we knew that the numbers would work out that way, if we had perfect foresight. We don't. But these things tend to work roughly. So yes, you're right. When markets get expensive, the longer term returns tend to come down. So that has been the case. And where the valuation has fallen, as it did in bonds a couple of years ago, the expected return has gone up. And that's why we've increased our sensitivity to interest rate within our bond portfolios, is because the expected return has gone up. And within equities, markets have gone up a lot. So yes, we're not going to see probably stellar returns every year. There will be some years when the market is down, but it's impossible to know when that is.
Yeah.
And that's the challenge, is that you can't sort of say, well, now's the time to get out and we'll take a year off, because if you miss out a short period of time, you can miss out the best.
Yeah, and you don't get it back.
You don't get it back, and we know the best days in the market are next to the worst days in the marketplace. So you've got to stay disciplined. And I think having that focus on the long term and not getting too upset by market volatility is important. And if expected returns fall, and they have come down a little bit, but it's not significant. We're talking about, at the margins, coming down from maybe sort of 6% for an average model portfolio to 5%.
Right.
So those are the kind of
perfect,
the kind of metrics, if you like, that's how it's changed, given how equities have gone up so much. There's that sort of diminished expected return, but it's still significant for long-term investors, and it's important to stay invested so you get those compounded returns.
And tying this to conversations we've had before, if you go back to what does that number mean and what is it about, it's about, can a particular client achieve their goals with their assets compounding at that rate? And for quite a lot of clients, that's a very robust rate, especially with the compounding effect and time and so forth. But that's helpful. I just wanted to try and tease that out a little bit. We've spoken many times about alignment for clients with portfolios by risk, by traditional investing, sustainable investing. One of the things that I know that I get as questions a lot more often is around philanthropy, which isn't quite your bag, but
I believe in philanthropy.
Very good. That's good. But it is something that comes up quite a lot. And I think the ability for clients to integrate their overall wealth plan with what they're doing with the capital they spend, what they're doing with the capital they invest, what they do with the capital they're philanthropic with, sort of all ties together.
It's quite a specialist skill, isn't it? Specialist knowledge.
It is. And I think, one of the things we hope to do is, in addition to these sessions where we're trying to improve and increase clients' knowledge and comfort on the investing side, is more sessions on this other type of capital allocation around philanthropy, and more sessions.
You're not expecting me to do those sessions, I hope.
Happily, I'm going to swap you out of that seat. Okay. We're going to have someone else come in and have a session, hopefully in the very near future, where we will talk specifically about that aspect of capital allocation around philanthropy and how it works and how to line up clients' expectations and values with that aspect of capital allocation. So clients hopefully can tune in for that element of that conversation. I think we can leave you with one final question, which is, overall, how are you feeling? Are you feeling optimistic, concerned, elated by the prior performance? How are you feeling?
I'm feeling pretty good. I'm feeling, we've had good performance. When I look back on how we've done, it's been great. It's been a good year. It's been, the last few years have been excellent. and that's good for clients, and happy clients is good for us. And going forward, I think the outlook is pretty good. I think economically, U.S. economy seems to be in a pretty good position. I think that I guess the risk to the market is that it becomes less driven by the Magnificent Seven. But because we're diversified, I think it's a risk that's not as relevant to us as maybe some. I think the things to be concerned about, like inflation, seem to be in the rearview mirror for now. And that's good for long-term investors. So I think there's a lot to be cheerful about. It's there's no shortage of headlines that are, preaching us about sort of uncertainty and bad things about to unfold. But when you look back on what we've been through in recent years or longer term, and then you look at the performance of the market around those points, it's, the market just digests these things, and there's short-term volatility, but more often than not, those tend to be buying opportunities. So, I'm very optimistic about our approach. I think it's really well placed at the moment. And I'm very excited about our future.
And I really appreciate that your comments around sort of staying the course. It made it really clear. It's not about us. It's not about us keeping these assets. It's about what's in the best interest of clients for them to achieve their goals. So I think your ability to frame that has been really, really helpful. Listen, thank you for your time.
No, my pleasure.
I'm sure we're going to have you back early in the new year. But for now, your perspective and your insights have been really, really helpful to our clients. So
cheers. Thanks, George.